Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at two stocks to consider buying ahead of their upcoming earnings releases later this week that might be worth holding on for the long term. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we take a look at these two pretty big stocks to consider buying ahead of their reports in the next several days, I want to just quickly look at the market as a whole to give a better context of what's going on with these two stocks. So if we look back to last week, the stock market posted back-to-back strong showings on Tuesday and Wednesday ahead of Thursday's crucial CPI release. Stocks since then have given up most of those gains as U.S. inflation officially climbed from 7% in December to 7.5% in January. So price inflation is remaining at 40-year highs, which is certainly hurting countless Americans and has serious impacts throughout the U.S. economy and beyond. So then on Monday, St. Louis Fed President James Bullard told CNBC that the central bank needs to fight inflation more aggressively. He was being interviewed. So he said, quote, I do think we need a front-loaded our planned removal of accommodation that we would have previously. We have been surprised to the upside on inflation. This is a lot of inflation. Our credibility is on the line here, and we do not have to, and we do have to react to the data. However, I do think we can do it in a way that is organized and not disruptive to the market. So essentially, he's saying that the Fed is going to raise rates more quickly right at the beginning. In the last several weeks, you've seen this kind of become more of a talking point that the Fed is going to raise rates in March, no matter what happens. And that first rate hike is going to be the most crucial. And then sort of you'll see what happens after that. If the economy starts to rebound with supply chains coming back fully online with the end of COVID restrictions, we'll see. But the first rate hikes and maybe the first couple will be the most important. So with Bullard essentially saying that outright, saying that they're going to front load their rate hikes, that their credibility is on the line, you're going to see rate hikes early on, and in March is definitely going to happen, and then kind of see what happens after that, which is kind of a good thing. And Wall Street's certainly pricing in those expectations already. So with this in mind, the S&P 500 is up roughly 2% off those January lows as it's come down from last week's rebound. So it's swung back and forth above and below its 200-day moving average over the last few weeks after climbing below it for the first time since that initial COVID sell-off to begin 2022. Meanwhile, the 10-year U.S. Treasury is above 2% for the first time since the summer of 2019. And overall, this is the backdrop we have at the moment, and we're going to see the Fed raise rates, so we're going to see rates likely climb even more. That said, though, 2% is roughly the median over the last decade for the 10-year U.S. Treasury, and it's never hovered barely above 3% for much at all over the last decade. So rates will remain historically accommodating to the stock market in general, and we've already seen the heavy selling recalibrate stocks significantly, valuations coming down to much more reasonable levels. With all of this in mind, we certainly could still have a choppier 2022 following 3 years of huge returns, but Wall Street has proven that it's willing to buy strong stocks at discounts and even slowly nibble on some beaten down growth names. And obviously, some people might just want to remain out of the market in general amid these unknowns and rising rates. But if you're a longer-term investor, it's pretty prudent to at least be buying stocks now, even if they maybe fall further in the next few months or in 2022. If you're planning to hold it for the long haul, it's better to not try to say I'm going to wait for the comeback, because it's impossible to call a bottom and it can prevent you from missing out on the ride back up. So on top of all that, the outlook for earnings for the S&P 500 for 2022 and 2023 is really strong, as are margins and revenue. So especially if we look in the margins front, our most recent Zacks data for S&P 500 margins is projecting them to climb from 13.1% in 2021 to 13.3% in 2022, and then all the way up to nearly 14% at 13.9% in 2023. And all of this would crush 2019's 11.5%, so that pre-COVID margins in all be historically high. So margins are just continuing to climb and prove resilient despite these rising prices and supply chain setbacks, which shows how efficient these companies are becoming, and especially the significance of tech at the moment and going forward. So with this all in mind, if you're an investor who still wants to stay in the market and you have a longer term outlook, we're going to take a look at two stocks that might be worth considering that are reporting their quarterly results this week, and they're both within the broader retail / e-commerce space. And the first one we're going to look at is Shopify, which trades in the ticker SHOP, so SHOP, and the company is set to release its fourth quarter fiscal 2021 financial results before the market opens on Wednesday, February 16th. So before the opening bell this Wednesday, the 16th. And now we're just going to jump into all things Shopify. So Shopify was a Wall Street star way before the pandemic, as businesses of all stripes turned to the company for really all things e-commerce. Since then, or recently, I should say, the stock has tumbled since hitting fresh highs as recently as November. And this pullback could set up a nice buying opportunity. So Shopify provides what it calls, quote, the essential internet infrastructure for commerce. This is everything from site design and marketing to payments and shipping. They make money from reoccurring subscription fees and tons of various add-ons to really help run many other core business functions. The company also produces point of sale products and software, and it's slowly growing a more unified approach to its in-person and digital offerings, especially which will be important as more of these shops are trying to have people come back into their stores as people return to their normal lives. The company also boasts that it powers 1.7 million businesses in nearly 175 countries around the world, so it's all over the place. And as we all know, e-commerce is certainly the future and the present, and the company offers different tiers, with some aimed as entrepreneurs and small businesses to high volume merchants. So really broad range of customers as well. And we should note that Shopify, Amazon, and really all these other digital commerce companies and the core big retailers have tons of growth runway, since e-commerce still accounted for only 13.1% of total US retail sales. Q3 of 2021, that's the most recent data I found, and this is from the US census, and that's up from just 10% in 2019, but still only 13% of all retail sales, and that's down from, I think, about 16% at the height of COVID. So still plenty of room to grow when you consider how small e-commerce is in terms of all of US retail sales. So in terms of Shopify's price movement, the stock skyrocketed from around $70 a share in 2017 to top $1,700 a share as recently as November. Those were those records. This run includes a 380% climb in the last 3 years, which takes into account even its recent drop. So Shopify's larger downturn of the past several months came as it became a victim of its own success and just the wave of growth-focused selling. Shop fell short also of our Q3 EPS estimates, in Wall Street started to become a tad concerned about its subdued growth outlook. So with this in mind, Zacks estimates call for 2021 revenue to surge 56% to about $4.6 billion, with 2022 set to come in another 33% higher. This would compare to 86% top line expansion in 2020 and a 67% average top line growth between FY19 and FY16. So obviously a slowdown, but that's always going to be the case as the top line actual figures get bigger and bigger. So percentage-wise, 2022 is clearly marking a slowdown in growth, but still the company is expected to add $1.5 billion to its top line, which is roughly its total revenue in all of 2019. So it's still growing significantly. It's just the percentage growth looks a little less impressive as the company matures and comes off of back-to-back years of really big growth, especially in 2020. Shopify's adjusted earnings are projected to climb by 61% in 2021 to $6.39 a share, and then come in another 8% higher in 2022. Not including its big Q3 bottom line miss, the company had consistently crushed our quarterly earnings estimates for years heading into that release. So maybe you could see more of that later this week. So overall, Shopify currently lands a Zacks rank number 3 hold, and its recalibrated valuation might still be a little too high for some. It's trading at a PEG ratio, which is PE ratio divided by its growth rate, of 6.4% or 6.4, not percent, at the moment. This is down from 66, a whopping 66, as recently as last April, in a 34 median over the past 12 months. Comparatively, Amazon's at 2.2 and Etsy's at 1.6, and the overall internet services market's at 1.1. So its valuation is still rich for some, but it's firmly focused on expansion, and it's really going all in on growth still. It has a strong balance sheet to support an array of possibilities going forward. This includes $7.5 billion in cash and equivalents in marketable securities, $8.3 billion in total assets against just $2.2 billion in total liabilities. So really impressive balance sheet. Wall Street is a little less bullish overall, with 15 of the 29 brokerage recommendations. Zacks has its strong bias with only one sell, which is down from what it was 6 months ago. That said, Shop is trading around 85% below its current Zacks consensus price target. And some investors might want to consider Shopify at the moment, even though the growth tech stack and growth tech in general might be a little out of favor. Shop's impressive operations might be worth a longer-term investment for those who are trying to play the e-commerce market outside of, say, Amazon and some other big growth names. Shopify still seems to be worth it, considering that the stock has come down about 50% in the last several months to trade well below its highs. And the next stock up we're going to take a look at is a much more mature retailer that's also growing in the e-commerce world, and that is Walmart, which trades on the ticker WMT. The retail giant will release its fourth quarter fiscal 2022 results before the market opens on Thursday, February 17th, so before the opening bell this Thursday morning. So overall, Walmart's revenue climbed 7% last year. That was its fiscal 2021, but it was 2020 in general. While its comparable sales climbed 9%, it expanded its delivery and various pickup options, and it helped overall e-commerce grow 80%. And last year was really a blockbuster year for Walmart. It hadn't grown at 7% for some time on the top line. So all of these efforts are helping it try to challenge some of the pure e-commerce players that are also growing now their own physical retail spots, and that is Amazon. So they have a popular relatively new service called Walmart Plus, which is sort of aiming to mimic Amazon Prime. The service costs $98 a year or $13 a month, and offers free deliveries, discounts on things like fuel, access to in-store checkout offerings, and some more. The most recent figures I could find there were that 32 million households had signed up for the service about 1 year in, and this was based on a Deutsche Bank report from September. Walmart is also focused on landing partnerships with up-and-coming digital retailers. This includes teaming up with secondhand clothing standouts like ThredUp, and even partnering with the company we just talked about, Shopify, to bring more small businesses to its own third-party market. The company is also benefiting from the growing overall digital advertising industry as more dollars are shifting away from legacy media. Obviously, Google and Facebook, now Meta, are still grabbing a lion's share of the overall digital advertising market. But as online searches begin on e-commerce sites, the money is flowing there. So Amazon's benefiting from this, and now Walmart is slowly benefiting from this as well. Walmart noted that its high-margin ad business is on track to be a multi-billion-dollar a year segment really soon, and They've also spent and partnered with some fintech firms to improve their own in-house financial service offerings. So continuing to just grow more and more and more in various aspects outside of straight up retail to help the company succeed over the long haul. And it's also built out its telehealth services around the country to complement its in-person Walmart health centers. So once again, just more growth outside of traditional retail to become a more diverse player long term. Walmart, like Target and Costco and some of the other big box retailers, posted its strongest performance in years in 2020, as we alluded to. Despite those tough comparisons, Zacks estimates are calling for its revenue to climb another 2.2% this year and another 2.8% higher next year, all the way up to $587 billion. And both of these do mark solid improvements from estimates earlier in the year. So it's continuing to outperform expectations and raise its outlook throughout this past year in terms of its top line growth. And these 2.2 and 2.8% is a far more normal growth pre-COVID. So continuing to grow on top of that blockbuster year, the heart of the pandemic. And at the bottom end, its adjusted earnings are projected to jump 17% and 5% respectively during this stretch. WMT has also topped our earnings per share estimates by 4% last quarter, 14% before that, and 39% in Q1. Like Shopify, it lands as Zacks ranking with your hold at the moment. It lands B grades for value and momentum in our style score system. And it's a part of a relatively high-ranked Zacks industry at the moment, that retail supermarkets. It's in the top 21%. And 12 of the 21 brokerage recommendations that Zacks has are at strong buys, with 3 more buys and then nothing below a hold. And it's 1.64% dividend yield, tops the S&P 500. It's 1.3%. Its industry is 1.58%, and Costco's 0.62%. So solid dividend yield, even though it's well below inflation at the moment and below the 10-year U.S. Treasury. Still solid considering the overall S&P 500 and some of its peers in its industry. With that in mind, Walmart stock is down about 7% over the last year compared to its industry's roughly sideways movement. And then if we look over the last 5 years, Walmart's up about 96%, with its recent underperformance over the last year plus helping it now match the S&P 500 over the last 5 years. The stock, the last time I looked on Monday morning, was down about 0.8% at around $134 a share, which puts it about 12% below its late November 2020 records and around where it was in July of 2020. So trading at a solid discount in terms of its price, with it not doing much over the last year and a half. Walmart is also now trading at 2-year lows in terms of valuation at 20 times forward 12-month earnings and 15% below its median, and nearly 30% off its highs during this stretch. It's also now trading around 7% below its 5-year median. So if we look back even further, valuation is pretty solid. And that's coming as the S&P 500 trades 7% above its 5-year median in terms of forward 12-month earnings. So if you're a longer-term investor who wants a retail giant who's certainly trying to become a more diverse and better company going forward for the long haul, that's never going to go out of style, at least not anytime in the nearly imaginable future, to just be a nice, solid addition to your portfolio at a really nice entry point for the long haul, you might want to consider Walmart at the moment, heading into their upcoming earnings release. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.